The cold wind of late October 1907 swept through the narrow canyons of New York City, making the steel and granite towers of the financial district feel even more imposing. As dawn broke over Wall Street, it revealed an unsettling sight. Lines of men that seemed endless, stretching around corners and filling sidewalks. Their breath clouded in the chilled morning air, but it wasn't the temperature that made them shiver. It was fear. A deep, unspoken fear that the savings they had spent their lives building were slipping away, hidden behind the heavy doors of banks and trust companies. Some men stared quietly at the pavement. Others clutched their withdrawal slips with trembling hands. Many whispered rumors they had heard in taverns, newspapers, and crowded train cars. Something had gone terribly wrong in the heart of America's financial world, and no one knew how far the damage would spread. Beneath the surface, the United States had been living in a golden age. Factories roared with new inventions. Railroads tied the nation together. Immigrants poured into cities searching for opportunity. Millionaires rose to fame almost overnight. Yet for all its energy and innovation, the country lacked one essential thing: stability. There was no central bank, no coordinated safety net, and no unified authority capable of controlling crises. Instead, the economy depended on a patchwork of private banks and trust companies, many of which operated with little oversight. They held the nation's savings, yet they played by their own rules, investing money in riskier ventures than traditional banks ever dared. The country was growing fast, but it was also growing recklessly. The first spark that ignited the coming inferno began quietly, almost invisibly. Two brothers, F. Augustus and Otto Heinze, bold, ambitious, and eager to make their mark, believed they could corner the stock of the United Copper Company. Their plan relied on precision, timing, and borrowed money. They intended to squeeze short sellers into buying back shares at high prices, creating a fortune overnight. But the market is rarely kind to speculation. The moment their plan faltered, it collapsed completely. Brokers demanded repayment. Investors panicked. Loans were called in. The Heinze brothers' empire dissolved before their eyes. What they didn't know, what no one knew at that moment, was that this single failure would send shockwaves across the entire American financial system. The collapse of the United Copper Scheme didn't end with the Heinze brothers. Instead, it exposed their hidden connections to major banks and trust companies. The most damaging connection of all was to the Knickerbocker Trust Company, one of the largest and most respected trust companies in the nation. Its president, Charles T. Barney, was rumored to have been involved with the Heinze Circle. Rumor alone was enough to spark fear. And fear, in a system built entirely on trust, spreads faster than any fire. People rushed to Knickerbocker's doors demanding their deposits. Within hours, the trust was overwhelmed. The line outside grew into a sea of terrified depositors, stretching for blocks. When Knickerbocker Trust ultimately shut its doors, it delivered a devastating message. If a major institution like this could fail, then nowhere was safe. The impact was immediate and brutal. Across the city, alarm spread through banks, trust companies, businesses, factories, and every home that relied on savings. Crowds formed outside financial buildings before sunrise. Bank tellers counted cash until their fingers bled. Managers barricaded back rooms filled with anxious employees. Every hour, the lines outside grew longer, louder, more desperate. Newspapers printed sensational headlines that only deepened the panic. People pulled their money out of institutions that had nothing to do with the crisis, simply because they feared they might be next. Confidence collapsed, and with it, so did the fragile structure of the nation's economy. The U.S. government watched helplessly. There was no Federal Reserve, no central authority to step in, no safety mechanism to stop the bleeding. The financial world was unraveling rapidly, and only one man possessed the influence, wealth, and authority to attempt a rescue: John Pierpont Morgan. J.P. Morgan's presence was enough to silence any room. With his piercing eyes, broad frame, and unmatched influence, he commanded respect from every banker, railroad magnate, and industrial leader in America. As the crisis deepened, Morgan transformed his private library on Madison Avenue into the nerve center of the rescue operation. The room looked more like a fortress than a meeting space. Dark wood, tall shelves filled with centuries-old books, heavy doors that closed with a thud. Inside that library, the fate of the American financial system would be decided. Morgan summoned the most powerful men in finance. Some arrived confident, others arrived trembling. But once they stepped inside, they understood the severity of the crisis. Morgan demanded reports, balance sheets, and financial statements. He worked late into the night, analyzing the solvency of every major trust company and bank. If an institution was weak, Morgan said so without hesitation. If it was strong, he organized funding to protect it from panic. His decisions were final, unquestioned, and delivered with unmatched authority. But saving the system required more than analysis. It required cooperation. And cooperation was not something New York's banking elite were accustomed to. They argued, resisted, and feared committing their own funds. At one point, Morgan ordered the doors locked and told the bankers that no one would leave until they agreed to provide the money needed to stabilize the system. Hours passed. Tensions rose. Voices cracked. But slowly, under Morgan's relentless pressure, they conceded. Millions of dollars were pledged to rescue failing institutions. It was a historic moment of forced unity in the face of catastrophe. Meanwhile, the city outside continued to tremble. A woman selling newspapers on the corner of Wall and Nassau watched men rush up and down the streets with frantic expressions. Inside small apartments, families counted their savings again and again, terrified it would soon be worthless. In factories, workers whispered about layoffs. Merchants refused checks. Restaurants saw business collapse. Trolley cars rattled through the streets carrying passengers who spoke of nothing but the panic. Every rumor became a threat. Every whisper became a warning. The city that once symbolized opportunity and prosperity was now trapped in a cloud of uncertainty. Then came the most terrifying moment of all, the imminent shutdown of the New York Stock Exchange. With credit frozen and brokers unable to secure cash, the exchange announced it was moments away from closing its doors. A shutdown would have triggered a chain reaction of bankruptcies across the country. Morgan understood the severity instantly. He ordered another emergency meeting. In that dim, crowded library, he demanded the bankers provide more funds, more than they had ever given before. After tense negotiations, they agreed. $25 million was provided to keep the stock exchange alive. It was a moment that prevented complete financial collapse. Gradually, confidence began to return. Banks reopened, lines shortened, newspapers went from panic to relief. The stock market stabilized. The city took a long, shaky breath. But the crisis had left scars. It had exposed the weaknesses of a system that depended entirely on private individuals rather than regulated institutions. It showed how quickly rumors could topple trust companies, how fragile the financial structure truly was, and how deeply the nation needed reform. In the years that followed, investigations began. Congress summoned bankers, economists, and business leaders to understand what had gone wrong and how to prevent future crises. Their conclusion was unmistakable. A modern nation required a central banking system. It required a lender of last resort, a regulator of credit, and a guardian against panic. In 1913, the Federal Reserve Act was passed, officially creating the Federal Reserve System. The system that failed in 1907 would never be allowed to fail that way again. Even today, more than a century later, the panic of 1907 stands as a powerful reminder. It shows how fragile confidence is, how quickly fear can spread, how interdependent markets truly are, and how leadership, decisive, forceful, and unified, can pull a nation back from the edge. The crisis reshaped not only American finance, but global finance. It taught lessons that still guide policy, regulation, and crisis response in the modern world. It is a story of ambition and failure, of fear and courage, of chaos and transformation. It begins with a cold October morning in New York and ends with the birth of a new financial era. And it remains one of the most dramatic, defining moments in the history of Wall Street.